You've probably heard that the S&P 500 delivers an average annualized return of 10%. I've said it myself, and I've even used that number in the past videos when running calculations. There is truth to it, but there's also a catch. That 10% is not a steady guaranteed paycheck each year. It's the long-term historical average, and what investors actually experience can be very different. By the end of this video, you'll understand why counting on a 10% every year might be overly optimistic, and why planning for a more realistic 6 to 7% could make or break your financial future. For those of you who don't know me, I've been investing for over 15 years now, and I make these videos so you don't make the mistakes that I have made and share what has actually worked for me over these years. Okay, first, let's talk about inflation. If you earn a 7% return and inflation is running at 0%, you've grown your purchasing power by 7%. But if you earn 7% and inflation is running at 3%, your real growth, or what you can actually buy with your money, is only about 4%. Inflation does not show up as a line item on your statement, but it's constantly at work in the background. When financial folks quote that the stock market's long-term average is approximately 10%, that is before inflation. Historically, inflation in the US has averaged around 2 to 3% per year. So a 10% nominal return, and nominal, by the way, means including inflation, might equate to roughly 7% real return after subtracting inflation. All this to prove a point that investors live on real returns and not nominal returns. Next, let's talk about fees. Investing is not free. Even index funds, which are designed to mirror the market, come with expense ratios, which are the annual fees charged by the fund's company. These fees might seem tiny, often a fraction of a percentage, but over time they can add up and compound against you. The good news is that index funds today are extremely low cost compared to decades past. Many popular S&P 500 index funds have expense ratios near zero. For example, Fidelity 500's index fund charges about 0.15%, and Schwab's S&P 500 index fund charges 0.02%, and my favorite, Vanguard's S&P 500 ETF, BOO, charges around 0.03%. These are almost negligible fees. If you invest $10,000, a 0.02% fees is only about $2 per year. That's not a big deal. However, if you're investing in active funds, you could be paying a lot more. Some active funds charge as much as 1% in fees. One analysis showed that assuming a 6% gross return over 30 years, a 1% expense ratio would reduce the final portfolio by roughly 25%, and a 2.5% expense ratio would slash it by about 50%. I stick with index funds that charge less than 0.1%. Pay attention not just to the fund expense ratio, but also to the advisory fee that you might be paying for management. Next up, taxes. Just when you thought that you earned a 10% return from the market, along comes the taxman to claim his share. Investing in a taxable account, or a normal brokerage account, means that you owe taxes on the profits you make. There are two main taxes that investors face: capital gains taxes, which are on the profits when you sell an investment, and dividend tax, on dividends that your stocks or funds pay out. How much do taxes affect returns? It varies by individual and situation, but studies have tried to estimate the general tax drag. One extensive Morningstar study shows that taxes can reduce a portfolio return by up to 2% per year on average for investors who are not using tax-efficient strategies. 2% per year is huge. That alone is in the same ballpark as the long-term inflation rate, or a typical fund's expense ratio times 10. The simplest way to mitigate the tax drag is to use tax-advantage accounts whenever possible. This includes your 401ks, your IRAs, or your Roth IRAs, where either the taxes are deferred or eliminated on investment growth. In a Roth IRA, for example, the entire 10% or whatever you earn is yours to keep, tax-free forever. In a traditional 401k, you don't pay taxes on dividends and gains as you go. You only pay income taxes when you withdraw the funds in retirement. By sheltering your investments, you can potentially save 1 to 2% per year in returns that would have gone to taxes otherwise, which can massively boost your long-term gains. Now, let's shift our focus from the accumulation phase, when we're saving and building a nest egg, to the withdrawal phase, when we're actually withdrawing money from our nest egg. You might think that if you and your friend both average 7% annual return over 20 years, it should not matter if one of you had bad years early on and the other had bad years later. A 7% return is 7%, right? Unfortunately, when you're taking money out, the order of returns can profoundly affect how long your portfolio lasts. This is called sequence of returns risk. It's a bit of a tricky concept, but Here's the gist. If you experience poor returns, like a market crash or a bear market, in the early years of your retirement while you're withdrawing your funds, your portfolio's value gets dented harder and it may never fully recover because you're selling assets when they're down to fund your living expenses. That leaves you with less capital to regrow when the market eventually bounces back. Conversely, if bad years happen later on, your portfolio is larger, so a later hit, while not fun, is still more survivable. In short, the order of returns can matter as much as the average return over the years. As an example, Alice and Bob each have $1 million in index funds, and each are planning to withdraw $50,000 per year. The average market returns over the next 18 years turn out to be the exact same for both of them. Let's say it was a pretty normal period, averaging around 67%, but the sequence is completely different. Alice enters retirement and is immediately hit with a rough patch. In the first 2 years of her retirement, the market drops 15% each year. After that, the market recovers and does moderately well for years. Bob, on the other hand, has great luck initially. His first 9 years are solid gains, and then the 15% market drop hits in years 10 and 11 of his retirement instead, when his portfolio is a lot larger because of prior growth. Now, over 18 years, assuming that both Alice and Bob experience the same set of yearly returns, just in a different order, Alice's early declines means that she had to sell her portfolio at lower prices to meet her $50,000 withdrawals. Bob, on the other hand, did not have to do that. His portfolio kept growing in the early years when he withdrew, and his portfolio was big enough to absorb the shock in the later years. According to this analysis by Charles Schwab, a scenario like this leaves the early loss retiree, which is Alice, completely out of money by around year 18, whereas Bob, after 18 years, still has nearly $400,000 left in his portfolio. Same average returns, same withdrawals, but completely different outcomes. This is sequence of returns risk in action. Long story short, negative returns can hurt your portfolio a lot more at the start of retirement than later on. This can be mitigated using strategies like the bucket strategy, where you divide your investments into 3 different buckets: the short-term bucket, the medium-term bucket, and the long-term bucket. I've talked about this multiple times on previous videos. Lastly, let's talk about the behavior gap. Why investors often earn less. If the market returns approximately 10% per year on average, one might assume that every investor in a basic S&P 500 index fund gets 10%. Surprisingly, many investors underperform the market, often by a wide margin. How is this possible if they're investing in the market? The answer usually lies not with the investment, but the investor's behavior, the tendency to buy, sell, and tweak at the wrong times. Take a look at this chart. It shows the annualized returns of various investments over a 20-year period. The S&P 500 in green earned about 8.2% annually. But you see that tiny orange bar on the far right? That's the average investor's return, only 2.1% per year. That's barely above inflation rate of approximately 2.2% for the same period, meaning the typical investor almost only broke even in real terms. Why so low? Well, the hypothesis and common sense says that it's because too many investors panic sell during market downturns and miss the recoveries, or they chase hot stocks or funds at the peak and then bail out at the very wrong moments. In other words, buying high and selling low, the exact opposite of the classic advice. The takeaway here is that you don't automatically get market returns just by being invested at some point. You have to stay invested throughout the roller coaster to capture the average gains. By now, it's clear that the often quoted 10% figure does not equal a guaranteed 10% return that you will get year in, year out. There is a best case scenario that you will invest with no fees. There will be no tax drags, you won't make any behavioral mistakes, and inflation stays low, and you start withdrawing money at a decent time when there is no catastrophic downturns. In that rosy world, maybe you could come close to matching the market's raw returns. But a far more realistic scenario is to assume something a bit lower, perhaps a 6 to 7% return to account for all the real-world factors. The overarching idea is this: don't assume a straight 10% return year in, year after in your retirement projections. Build the possibility of a market decline in the early years of retirement. Think of taxes, think of inflation, think of fees, and most importantly, stress your plan against all these scenarios.